Chapter 14, Real Estate and Federal Taxation. To start this chapter off, I want to talk about capital gains. Capital gains is simply the profit that a person has on a capital asset. And let me define for you what a capital asset is. A capital asset is anything that we've acquired for income, business, or investment. And anytime that you purchase a capital asset, later sell it, and can make a profit, that's called a capital gain. Now you can also have a capital loss as well. I want to go over with you quickly the dynamics of how you calculate a capital gain, because you'll probably see that again on either my examination or the state examination. The first thing that you're going to do is you're going to take the purchase price, then you're going to add your closing cost. That'll give you the original basis in the property. The next thing you're going to do later when you sell it, you'll take the sales price minus your closing cost, which will give you the adjusted sales price. Notice that the closing costs are either added or subtracted. Therefore, they are non-taxable items. So once you get your adjusted sales price, you'll subtract away the original basis, and that'll give you your gains. Of course, it's a little bit more complicated than that if you have improvements and other things, but that's the basic calculation. I want to talk now about the principal resident or primary resident we have. There's a special tax treatment that we have when we own real property that's considered our primary residence. As long as you live in it for at least 24 months out of the past 5 years, if you're an individual filing separately, you can exclude or exempt up to $250,000 of gain. If you're married filing jointly, that number is up to $500,000 of gain that you can exempt from tax purposes. And once again, all you need to do is at least live in it for 24 months out of the last 5 years. Now that 24 months does not have to be contiguous. There are some other caveats to this tax code. One of them is that if you've rented it out, there's going to be some prorations that you have to deal with, and that's another subject. Real estate investment operations. I want to go over with you cash flows one more time to make sure that you understand how the cash flows work. Remember, the first thing that we want to do is calculate our potential gross income. That's the maximum income that a property can possibly generate under the very best terms and conditions, and that is if it's 100% occupied. We know that most properties will not be 100% occupied. As a matter of fact, most experts will tell you, and my experience has been, that if you're running about a 5% vacancy, you're really maximizing the property's potential. Typically speaking, if you're 100% occupied, your rents are a little too low. Once you've calculated your potential gross income, and by the way, that again through market rent or contract rent, we're going to subtract away vacancy and collection losses. Those are individuals that are either not there participating to pay or that are there and simply aren't paying. Once we subtract out our vacancy and collection losses, that's going to give us effective gross income. Effective gross income is the real money that we have to pay our bills with. Remember that our bills fall into three categories. We have fixed expenses, which are your taxes and insurance, variable expenses, which are maintenance, utilities, and management, things of that nature, things that will fluctuate with occupancy. Then we have reserves for replacement, which we're putting money in a little bank account, setting it aside to pay for things that break later. Remember that if we don't use that money, later we'll have to bring it back in and pay taxes on it. That gives us our net operating income. Now, at that point, most investors would like to take it one step further. I mentioned earlier that your mortgage payment is not considered to be an operating expense. At this point, once we've calculated the net operating income, we want to subtract away our mortgage payment. Another word for mortgage payment is debt service. When we subtract away our debt service, that gives us our cash throw-off, or better known as before tax cash flow. In other words, this is the cash flow that we have to put into our pocket before we have to pay our income taxes. At this point, we have to calculate our income taxes. We simply take whatever our taxable income is, figure out what our tax rate is, and calculate it from there. And I'm going to go over that formula with you in a second. But what ultimately we're looking for is going to be after-tax cash flow. To calculate our depreciation, let me make a comment about depreciation or cost recovery. There are some exemptions that we have when we own real property that we can write off. Usually the interest on our mortgage is going to be a deduction, but also cost recovery, which is a form of depreciation. A property doesn't really depreciate. What happens is that we're recovering the cost of the improvement over time. If it's a residential property, we can take cost recovery over 27 and a half years. If the property is non-residential, we can take that cost recovery over 39 years. And remember that we're only depreciating or recovering the cost of the building only. We separate the building from the land. Also, let me say that when we're talking about our basis for depreciation, we can also include closing costs. So we take our purchase price plus closing costs gives us our basis for depreciation as well. To calculate our taxable income, we're simply going to take net operating income. We're going to add those reserves back into it if we don't spend it. Remember we said that if we set some money aside to pay for things that break, if we don't spend it, we've got to pay taxes on it. So we're going to add reserves back. Remember our two big deductions that we have, the interest on our mortgage and cost recovery. Those are the two deductions we get. When you subtract these out, that's going to give us taxable income. And from our taxable income, we simply multiply whatever our tax base is or our tax rate. That'll give us our income taxes. Real estate has been categorized to be a passive activity. In other words, what they're basically saying is, as a passive activity, if you have gains from something else, such as your ordinary income or some other type of operation, you can't use any losses that you have there to offset gains in real estate, or vice versa. You can't take losses in real estate to offset gains in some other areas, except under certain conditions. The sale of investment properties, the calculation for that is going to be a fairly simple calculation. You're simply going to take your sales price minus any of your expenses is going to give you your net sales price. Then what you're going to do from there is you're going to subtract away that adjusted basis. And that'll give you whatever that capital gains is that is realized. Now, I want at this point distinguish the difference between realized and recognized. When you sell your primary residence and you've lived in it for at least 24 months out of the last 5 years, the first of the $250,000 that you have is exempt from taxation. That's still going to be realized gain. But the thing is, because you're not going to pay taxes on it, you're going to subtract that out. So whatever's left over that you actually write a check for is considered to be recognized gain. Methods of deferring taxes. There are two ways that we can actually do that. First of all, the installment sale. The best way to remember an installment sale, this is seller financing. If you were to sell a property and you had a gain of, say, $300,000, that's going to put you in the upper tax bracket. Plus, you have to pay taxes on that gain in the year that you collected it. If you do an installment sale, what you're doing is, let's say you take that $300,000 and you take it, do seller financing over 10 years. That would give you $30,000 a year in revenues coming in this gain. First of all, that's going to probably lower your tax base. Secondly, you're only paying taxes in those years out over that 10-year, which means you're deferring it over time. The other method of deferring taxes, or one other method of deferring taxes, is the 1031 exchange. We call that the tax deferred exchange. Now, there's nothing that's free. I hear people say, well, that's a tax-free exchange. No, it's not. But it is deferring taxes. And the properties that you can defer are like-kind properties. Now, let me define for you like-kind properties. It's anything that you bought for income, business, or investment. That sounds like a capital asset, doesn't it? Well, it is, but there's two exclusions. To begin with, your primary resident cannot be included in this tax-deferred exchange. I mean, you can exchange it, but it already has a pretty good tax benefit like it is. So that's got to be excluded. Secondly, dealer inventory. Dealer inventory is where a builder goes out and builds a subdivision for resale. All those homes built for resale are considered dealer inventory and are non-exchangeable. The only way that they could possibly exchange those, if they placed them in some kind of a rental pool, proved to the IRS they put them in there for enough time, that they advertise them properly, then they might be able to do that. Otherwise, they're non-exchangeable. But we can exchange like-kind properties. I can exchange a warehouse for an apartment for vacant land for a shopping center. You can mix and match. Remember, anything that you bought for income, business, or investment can be exchanged equally. But now, if they're not equal, probably cash is going to be involved. Anything that's not part of the exchange itself, that equal exchange, is considered to be boot. So a good way to remember boot, and by the way, boot is taxable. Whoever is receiving the boot gets the boot. In other words, if a $150,000 property is being exchanged for a $200,000 property, that $150,000 is moving up and probably going to have to bring cash. That $250,000 is moving down and receiving the cash. So whoever is buying down or exchanging down is going to end up paying taxes on the boot. And that's all we have for chapter 14. What I'd like to do right now, I'd like to review with you the summary, go over those areas that are going to be of critical concern. A capital asset is anything purchased for income, business, or investment. A capital gain is any profit earned when a capital asset is sold. The primary residence is held for 24 months out of the last 5 years. First, if you're married, filing jointly, up to $500,000 of gain is exempt. If you're filing individually, up to $250,000 is exempt. If a vacation home is rented for fewer than 15 days each year, it is considered to be a second home, and the 15 days or more is considered to be an income-producing property. The significance of that is that if it's an income-producing property, there are expenses you can write off. If it's a second home, you can't. Residential income properties depreciate over a 27.5-year period, whereas non-residential real estate properties depreciate over 39 years. The basis for depreciation is your purchase price plus closing cost times whatever percent of the building value. Remember, we're only depreciating the building. So if the building is 80% to the land's 20%, it's only the 80% of the building that's depreciating. After-tax cash flow is calculated by potential gross income minus vacancy and collection losses. And by the way, after that, we're going to add in any other income that might be coming in, such as vending machines. Vending machines and those kinds of things you don't take vacancy against. That should give us effective gross income. From effective gross income, we're going to subtract out all of our operating expenses. That'll give us net operating income. From net income, we're going to subtract out our annual debt service or our annual mortgage payment. That'll give us before-tax cash flow, also known as cash throw-off. From there, we subtract out our income taxes, and that gives us after-tax cash flow. The installment sale is seller financing that allow the seller to take gain over time, which may reduce their tax bracket. The tax-deferred exchange is like-kind properties, and remember that's anything that we buy for income, business, or investment, and your primary resident is not considered as part of an exchangeable item, as is dealer inventory. Boot can be cash or other unlike items, such as the difference in mortgages, and those are not exchangeable, and you pay taxes on the boot in the year that you do the exchange. Also remember that in an exchange you have to have a qualified mediator who has to handle the exchange, and all you're doing with the tax-deferred exchange, it's not tax-free, you're simply postponing it to a later date. And that's all we have for Chapter 14 summary.